Thank you so much, gentlemen, for joining me today. And I'm so anxious to hear about your market outlook. So tell me, Freddie and Adam, how has GDP growth this year impacted the markets?
Well, I think in large part, GDP has disappointed, and the effect, somewhat, I would say, is the opposite effect of what some might assume. We're kind of one of those periods where economic realities have diverged from market realities, large part due to the fact that a lower GDP number or a lower inflation number gives the market some excitement that there's increased possibility that the Federal Reserve will start to cut rates sooner rather than later. So that's a dynamic we're in, where the fact that GDP is coming in lower than expected has actually helped to bolster markets in general.
Okay. And what do you anticipate will happen with interest rates in the second half of this year?
Yeah, so we're kind of seeing in modeling that inflation will start to decelerate more quickly here in the back half of the year towards that 2% target that the Fed has. And so the flip side of that, even if the Fed doesn't start to cut rates, we do foresee that on the longer end of the curve, we're talking about 10-year or 30-year type interest rates, or for consumers or mortgages, we would expect those to start to decline alongside of that decline in inflation in the back half of the year.
What are the key factors impacting inflation? And you just mentioned this. Will the U.S. reach the Fed's 2% goal this year?
Not that we reach the 2% this year. Really, the things that are driving inflation will kind of give the tale of two different market or two different 2024. So the beginning of the year, inflation has been a little bit stickier than what we expected, and that's why we've seen that the Fed hasn't taken any action to cut rates. That's largely driven by the fact that the unemployment rate has remained somewhat stable up until these last couple months. And what we've seen just now is that we've actually tipped over above a 4% unemployment rate. So first half of the year, inflation is really driven by the fact that consumer habits, spending have remained quite resilient. And that's a large part due to the fact that, the labor market has remained strong. But what we're starting to see, and kind of what we foresee going into the back half of the year, is that the labor market starts to weaken, and you'll start to see consumer spending habits decline. And in a large part, that's due to the fact that, that the ability for consumers to take out more credit, that's pretty much reached its maximum point. And so you're just really starting to see signs that the consumer is stretched too thin, which will obviously bleed into a lower spending and inflation rate.
Okay. And so, you guys, what is your take on the S&P 500's incredible growth in the last 18 months? And do you think this growth can continue?
So we're seeing quite a few signs of economic weakness, as Adam touched on, including a decrease in job growth, rise in unemployment. We've seen retail sales finally come in a little bit weak, so we're seeing some consumer fatigue. And on top of that, you have a market that's been increasingly top heavy, being held up by the largest stocks in the S&P. The top 10 stocks now make up over 35% of the index, with NVIDIA's market cap reaching that of Apple and Microsoft. Also, if you look at the last 2 years, the S&P has outperformed the equal weight index by about 15%. So the S&P is very reliant on these companies. Looking at earnings growth rates, we're looking at about 8%, which puts the valuation at about 23 times earnings. All of this to say, really, that when we do get a rotation out of these big names, it's going to be pretty difficult for the index to maintain its current levels. The top tech stocks are going to have to consistently put forth double-digit earnings and revenue growths for current levels to be sustainable.
Okay. Wow. Let's see. Have there been any changes in the trends around consumer spending this year?
Yeah, and I kind of hit on that earlier, that we've seen consumer sentiment remain resilient, and spending in the first half was also resilient. But what we've noticed is that retail sales in the last couple months have declined quite a bit, And so we are seeing that trajectory of where higher interest rates is finally starting to bleed through to the consumer. So it hasn't had a big effect, like I said, in the first half of the year, but we're starting to see that roll over where it is starting to have a bigger effect on consumers.
Are there any sectors in the market that our clients have overexposure or underexposure to?
Yeah, so we just touched on retail sales. Consumers, we think, are going to be pretty reserved with their spending, and a decrease in income is obviously going to be negative for the sector. Some of the top holdings within the sector include Home Depot, Lowe's, Nike, Starbucks, companies that we've seen earnings come out for over the last month or so, and they've quite frankly disappointed both on earnings and revenue guidance. So due to reduced profit margins and some overvaluation of these companies, we're going to remain underweight consumer discretionary sector moving forward. On the other side, an overweight that we're taking this quarter is to energy. We've seen domestic oil prices hover in the mid 70s to mid 80s, with oil volatility pretty low, and valuation at 12 times earnings is fairly attractive compared to a 5-year average of 19 times earnings. We think there's really a floor on energy prices right now with the geopolitical climate that we're seeing. We're also seeing quite a bit of M&A with $230 billion in deals going through over the last year. So to us, this indicates a strategic response to energy demand and production in the years ahead. So we've shifted to an overweight in energy.
I know you just kind of touched on this, but how have you shifted your portfolio asset allocations this past quarter?
Yeah, so I guess in general, our portfolios are positioned with a defensive tilt, both in core sector and core series. I spoke on our core sector defensive plays, but we're also maintaining a stance that we like growth where it's cheap and reasonable. For example, the communication services sector, that includes Alphabet and Meta, offers us growth rates over 15%, but it also gives us the highest earnings growth rate of 19%. So with those rates and valuation, that's pretty reasonable. That's one way we're still playing growth, taking an overweight there. Similarly, in the core series models, we have defensive ETFs like the dividend ETF and the equal weight ETF, but these are just sleeves. The main basis that we're taking, we still ultimately the majority of the exposure is in the basis, which is the S&P 500. So we're still capturing that upside that we're seeing in markets.
And finally, a lot of clients have been anxious and asking this question: what do you think the presidential election is going to do to the markets?
Yeah, that's a tough one. What I would say is, markets, they're not very political. They tend to really move based off of certainty or uncertainty. One of the advantages of this election cycle, at least in the current environment, is that both candidates have been president. So the markets kind of know what to expect, whether it's a Biden or a Trump who is elected as president. I think the real kind of uncertainty that we could see starts to shake up markets would be if for some reason Biden or Trump are not the ones running, and that would create that uncertainty that I spoke about, where markets don't know what to expect and start to try to price in additional risk that aren't in the market right now. I think that would be the thing that would increase volatility. But if things stay fairly status quo, whether it's Biden or Trump, I don't think it's going to have a big effect on markets as a whole.
Okay, good to know. Well, great. Well, thank you so much.
Yeah, thank you, Courtney.
Okay, take care. Have a good summer.